Gold just ripped higher by $139, a 3.4% surge off the $4,192 level, and yet, I'm absolutely not buying it. In fact, the single most dangerous thing you can do right now is chase this bounce. Why? Because every tick higher is dragging late long straight into a liquidation trap, built exactly at the level smart money has been defending for weeks. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. Session bias is clear. We are fading this rally within a powerful daily downtrend. Gold is not reversing. Gold is redistributing. The monthly trend may still flash strong buy, but the weekly and daily prints are screaming strong sell. And that conflict right there is the crack where the herd gets split open. Today's bounce is a mean reversion move inside a bearish continuation structure, not a new bull leg. The single invalidation level that flips everything is $4,221, the 200-day moving average. Write this number down. If we get a 4-hour candle close above 4,221, the entire bearish structure resets and we shift to neutral, possibly even a short covering spike toward 4,240. But until that happens, every rally toward that level is a reload for sellers. Here's the micro insight that matters. The herd is positioned long off the $4,192 bounce, with retail sentiment flipping euphoric because gold is a safe haven again. That is the exact fuel the market uses to engineer a liquidity grab. The safe haven story is overcrowded. The analyst notes literally say gold correction shows how safe haven trades can become overcrowded. When everyone is already leaning one way and the higher time frame trend is pointing the other way, it's a trap, not an opportunity. Let's walk the charts together, from the weekly straight down to the 60-minute, and you'll see exactly why this is a seller's playground. Start on the weekly. We've got a strong sell reading, and while I don't have the exact weekly moving averages on the screen, the slope of the 200-week moving average is flattening, acting like a gravitational pull from above. Gold's monster rally that started months ago has stalled, and the weekly close below 4,250 earlier this month killed the momentum. Drop to the daily chart. The daily trend is a strong sell, and we are currently trading at $4,210.89. Look at the moving averages. The 5-day moving average sits at 4,193. The 10-day at 4,167. The 20-day at 4,137. The 50-day at 4,122. And the 100-day at 4,149. But the real beast, the one that matters more than any other right now, is the 200-day moving average at 4,221. Price is below that line, and that line is acting like a brick wall. Every bounce over the last 2 weeks has been slapped down near this 200-day magnet. Today's high is testing that wall again. Now, zoom in on the oscillators, because this is where the trap tightens. The daily RSI is sitting at 78.3. That is deep overbought territory on a bounce within a downtrend. Exactly the kind of exhaustion reading that precedes reversals, not breakouts. The stochastic at 81.3 is confirming the overbought signal. And Williams %R is at -5.3, basically pinned to the ceiling. When you see a price that is rising into these readings while still below the 200-day moving average, it is not strength. It is the final gasp before a liquidity sweep lower, and here's what most traders miss. The ADX is at 58, which tells you the trend is extremely strong, but the CCI is at 120, flashing an extreme overbought condition. This combination means the trend is healthy to the downside, but the short-term bounce is stretched so far that it's about to snap back. Think of it like a rubber band pulled against the dominant trend. The snap is coming. Now drill into the 4-hour and 60-minute picture. The 5-hour trend is still a sell, yet the 1-hour trend has flipped to a strong buy. That is the definition of a counter-trend rally inside a higher time frame bearish structure. The pivot point for today is $4,219.01, almost perfectly aligned with the first resistance level at 4,219. Coincidence? Not at all. That zone, combined with the 200-day moving average at 4,221, creates a formidable supply wall. Support levels are stacked at $4,203.80, then $4,203.42, and the critical swing low at $4,198.59. If we lose the 4,198 zone, it's a straight shot to the deeper demand below 4,180. Meanwhile, resistance above 4,221 is at 4,223.84 and 4,229.22. Here's the hidden bearish divergence that retail doesn't see. On the 4-hour chart, while price bounced from 4,192 up to 4,215, the MACD histogram is failing to make a new high. The MACD line is at 32.7 and losing slope. That negative divergence means buyers are exhausted. They're pushing price higher with less and less momentum, classic distribution before a drop. The next signal changes everything. If the 1-hour chart prints a bearish engulfing candle below 4,210, that is the first confirmation that the trapdoor is opening. And if you see gold struggling to hold 4,203, the S1 level, on any retest, the liquidation cascade starts. Now let's connect this to the fear architect narrative. Gold is not moving in a vacuum. It is moving tick for tick with real yields and the US dollar. When real yields climb, gold gets crushed. And right now, the bond market is sniffing out a more hawkish Fed, even as some safe haven bids linger. That divergence, the conflict between geopolitical fear and rising yields, is exactly why the safe haven trade is overcrowded and ready to unravel. When the fear bid fades, the only thing left is a heavy technical structure that screams short. The last 24 hours of news didn't need to be dramatic to confirm this view. The core headline reads, Gold downtrend bounces at $4,192, live level. And the analyst sentiment is brutally honest. Gold correction shows how safe haven trades can become overcrowded. That is the fundamental anchor. Gold's entire rally this year was built on a fear bid, geopolitical tension, inflation angst, central bank buying. But when a trade gets too crowded, it reverses violently, often with no new news at all. We are in that unwind phase right now. Yesterday's ECB speaker subtly changed the cross-asset pulse, but the real driver is the policy divergence between the Federal Reserve and other central banks. The dollar is not falling apart. It's consolidating with a bid underneath, and that keeps gold pinned. Spreads between US real yields and German bonds are widening again, which historically pushes gold lower. And looking at Bitcoin, the risk asset shadow, BTC is struggling near key resistance as well, suggesting the speculative fever is cooling across the board. When Bitcoin drops and gold drops, it's a liquidity contraction, not a rotation. That strengthens the bearish gold case. My1 to 2-week directional lean is decisively lower. I'm looking for a break below 4,192, targeting the 4,150 zone, with an extension to 4,120 if the dollar breaks higher. The exact event that would invalidate this lean is a daily close above 4,225, or a sudden geopolitical shock that slams real yields back to the floor, but with the market already long safe havens, even that shock might just get sold into. Do you think gold breaks below 4,190 this week? Comment yes or no right now. I'm tracking consensus, and I'll read the results in tomorrow's video. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1, the sniper, conservative. This is the high probability, patience required setup for the swing trader who wants to sell the rally into resistance with confirmation. We wait for price to rally into the 4,219 to 4,221 sell zone. The entry trigger is a 1-hour bearish engulfing candle that closes below 4,218. Once that prints, you are in. Your stop loss goes above 4,225, above the R2 resistance and the 200-day moving average, giving the trade room to breathe but not so much that the risk-reward breaks. Logic: if bulls can't push above 4,225, the downtrend remains in control. Take profit 1 is at 4,205, just above the S1 support cluster, which offers a natural area for partial exits. Take profit 2 is at 4,193, the swing low that started this bounce. The risk-reward on this is roughly 1 to 3.1, assuming entry near 4,218 and a stop at 4,225. The setup is void if we get a daily close above 4,225. At that point the trap failed and we stand aside the sniper, conservative, entry, 42.19 to 42.21 zone, 1H bearish engulfing close below 42.18, stop loss, 42.25 take profit 1, 42.05 take profit 2, 41.93 risk, reward, (1:3.1 are invalidation, void if daily close above 42.25 strategy 2, the active trader, standard. If you want to capture the breakdown itself rather than the fade, this is the plan. We are looking for a loss of the $4,203 support region. Entry trigger is a 15-minute close below 4,202. That confirms the intraday structure has broken and momentum is shifting down. Your stop loss goes at 4,212, just above the recent consolidation range and the MA5 on the hourly chart. Target 1 is 4,195. Target 2 is 4,185. Once target 1 is hit, move the stop to break even and trail it by $20 using the 15-minute candlestick lows. This allows you to ride a potential extended move toward the 4,150 region without giving back profits. The risk-reward on this, even before the trail, is comfortably above 1 to 2 the active trader, standard, entry, 4,202, 15M close below, stop loss, 42.12 take profit 1, 41.95 take profit 2, 4,185, trail stop to break even after TP1, trailing rule, trail by $20 using 15M lows after TP1 invalidation, void if hourly close back above 42.15. Type your gold range for tomorrow's session in the comments now. Give me a low and a high. Let's see who's aligned with the liquidation zone. Strategy 3, the aggressor. High risk. This is a counter-trend momentum fade on a shorter time frame extreme, for those who can lose small and manage risk aggressively. With price hovering at 4,210, the hourly RSI is still elevated, and the 1-hour overbought condition is stretched. If you see a sharp spike toward 4,215 that fails immediately, you can enter a market short at 4,210 with a very tight stop at 4,218, just above the session high. Your target is quick, 4,198, the S3 and the heart of the bounce zone. If price gives you that move, take profit and walk away. Do not marry this trade. If gold breaks above 4,218 with conviction, you are out with a small loss. Only take this if you can stomach the heat and have strict discipline. The aggressor, high risk, entry, 4,210 market short on rejection at 42.15 stop loss, 42.18 take profit 1, 41.98 risk, air reward, (1:2.3 are invalidation, instant exit on 5M close above 42.18 never risk more than 1 to 2% of your account per trade. No positions through high-impact US data or surprise central bank speak. Stops are non-negotiable. The market does not care about your conviction. It will hunt your stops. This is how you survive to trade the next big move, so let's lock in. The single most critical level for the next session is 4,221, the 200-day moving average. As long as gold stays below that wall, every bounce is a sell. If we close above it, the entire bias needs a reassessment, but right now the path of least resistance is a freefall toward 4,190, and then lower. Tomorrow we have a wildcard. Any fresh comments from Fed officials or a surprise in the bond market could accelerate this breakdown. I'll be breaking down the dollar index and the S&P 500 gamma structure in the next video, because the equity gold divergence is flashing a warning that most traders are ignoring. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen, smash that like button if this gave you a clear plan. Subscribe,